Welcome to the Finance Garage podcast, your go-to podcast for navigating the world of finance. I'm Jonathan, your financial guide, bringing the latest market trends, investment strategies, and financial news that matters to you. And by the way, I'm also going to share my other passion, which is cars.
At the SWU Group, we help everyday families achieve financial success. Our integrated services include financial planning, accounting, credit advisory, and estate planning. We're here to guide and support you every step of the way, from custom investment strategies to maximizing tax efficiency. We ensure your financial goals are met with peace of mind. Visit simonwu.com.au for more information.
Hey everyone, and welcome back to another episode of the Finance Garage. As always, it's Jonathan Wu here, Senior Financial Advisor and Principal at the SWU Group. Now today I want to talk about one of the biggest tax traps in retirement, which unfortunately catches thousands of Australians' families every year without them even knowing. But they will know after someone dies. Now, we all know that most Australians spend decades building their super. We all work hard, we salary sacrifice to save a bit of tax, but also boost our superannuation savings, and we invest wisely. Then we all assume that because our super is tax-free once they're over 60 and they're retired, then our children will also receive it when we inevitably die, also tax-free as well. Unfortunately, that isn't always true. And in fact, many adult children receive an unexpected tax bill from mum or dad's super. Sometimes it's tens of thousands and sometimes it's over $200,000. So in today's episode, I want to explain why this happens, who pays it, how much it could actually be, and one of the best retirement strategies available today, which is called superannuation recontributions. So let's start with the why super is different bit first, because after doing this for 20 odd years, I still find that many people are confused as to whether or not super is something that's held in their own name. Now, first of all, it's not in your own name. It's held by a trustee, or in the case of a self-managed super fund, it's held by the trustee of the self-managed super fund. Now, that could be you, or it could be a corporate trustee. We usually advise people to use a corporate trustee as an extra layer of protection. And within your individual super account or your member balance within a self-managed super fund structure, not all of the money within it is treated equally. Your balance fundamentally is made up of two broad components. You've got a tax-free component and you've got a taxable component. Now, the tax-free component generally comes from a mixture of after-tax contributions, non-concessional contributions, and certain capital gains tax-exempt amounts. Fundamentally, this lot of money has already been taxed. Then you've got the taxable component, and this includes probably the majority of what most people have, which is employer super, salary sacrifice, other personal contributions where you're claiming a tax deduction, as well as investment earnings. So if you're, say, 60 years of age today, and if you reflect back on your entire superannuation journey, and you think about how that money fundamentally got in there in the first place, if someone had derived some sort of tax benefit, either through salary sacrifice, you through extra personal concessional contributions, or the employer who gets a tax deduction because it's an expense to contribute money into super, then your super account is likely to be somewhere between 80 and 100% taxable component. And you know what? That's perfectly normal. But here's where it creates the problem. If you withdraw your super yourself after the age of 60, it's usually tax-free, assuming that you're retired, no issues. But if you die, the tax outcome depends entirely on who inherits your super. Now, these people usually receive your super tax-free if they are what we call a tax dependent. Now, a tax dependent and a dependent as defined by superannuation law is also different. So again, pro tip, speak to your financial advisor about this. Tax dependents are broadly your spouse, children under 18, a financially dependent child, or someone in a interdependency relationship. So these people, if they were to inherit your super, vis-a-vis your binding death benefit nomination, no problems. Then you've got non-tax dependents, and here's where many families get caught, because adult independent children are not tax dependents under tax law. They may be your children, but for superannuation tax purposes, they're treated differently. And that means they can pay tax on the taxable component. Now the question is how much? Now generally the taxable component plus a Medicare levy can result in around a 17% tax on the taxed element within the taxable component. And then if there is an untaxed element within the taxable component, it can be considerably higher. But I can confidently say that that is quite a rarity given the invention of accumulation super accounts about 30 years ago compared to, say, defined benefit schemes, which work in a completely different manner. So let's bring out a simple example. Let's imagine mum passes away and she leaves her son a superannuation account worth $1.5 million. And we assume that 1.3 of the 1.5 is taxable and 200,000 is tax-free. The taxable portion may attract approximately 17%, or in dollar terms, that's about $221,000 immediately gone. That's money that mum spent 40 years building. It's completely legal and completely avoidable in many cases. Now everyone's probably asking, well, why does this happen? I've spent my entire life paying taxes. Why do I still have to pay tax, or why do my children have to pay tax? And this is probably the biggest distinction, because if you're someone who's already enjoying the fruits of your labor in retirement, you're converted to pension, this issue about super death benefits tax fundamentally isn't yours, it is your children's. And the reason why the government justifies this type of tax, which most people, as I said, don't know about it until it actually happens, is that their answer is that the money inside super received tax concessions while it was being accumulated. So the government says, well, if a spouse receives it after death, that's fine. If an independent adult child receives it, well, part of those concessions we need to claw back. Now, I'm not here to suggest whether we agree with it or not, it's just the rules. The important thing is understanding how the rules work early enough to plan properly. Now let's talk about this recontribution strategy. Now this is one of the smartest, in our opinion, retirement strategies available. And it's quite simple, but in practice it's harder to implement than you think. So broadly, there are two steps. You withdraw money from your super. If you're over 60 and you meet a condition of release, i.e. retirement, then withdrawal is generally tax-free. We broadly don't do it for clients that are still in accumulation phase because there are tax implications for that. But importantly, the withdrawal comes out proportionally from both your taxable and tax-free components. So after you've pulled the money out, step 2 is put the money straight back into super as a non-concessional contribution. Now this is where the magic happens. Every dollar you contribute back becomes 100% tax-free component. You've converted the taxable component money into tax-free component money. Same investment, same super fund, same owner, but a completely different tax outcome for your beneficiary.
Ready to take the first step in investing, or just looking to continue growing your wealth without being inundated with financial information? With SWU Online Invest, we offer a range of expertly managed portfolios designed to match your investment needs. Whether you're a seasoned investor or just getting started, know that we will work tirelessly to ensure your investments are strategically positioned to maximize your goals. Visit swuonlineinvest.com.au today.
Let's run through a simple example. Say John's age 67, he's got $1 million in super, and the breakdown between the taxable and the tax-free component is 95 and 5. So 95% taxable, 5% tax-free. Based on the rules as at the 1st of July 2026, the new financial year that we just started, he chooses to withdraw $130,000 and recontributes it. His tax-free component percentage immediately increases, and if he repeats that strategy over several years, he can dramatically reduce the taxable component, potentially saving his children tens or even hundreds of thousands of dollars in death benefits tax. Because if he does nothing, and he's got 95% in taxable component on a $1 million super balance, if he was to pass today and the money passes to his adult children, then your children will be up for paying around $160,000 in death benefits tax. Now that's a lot. To turbocharge the strategy even more, you can actually consider using the bring forward rule, which is utilizing this financial year, next financial year, and the following financial year's limits to contribute all in this year. And that way you can actually transfer $390,000 out and put it back in. The key thing to remember though is that you always start at a higher percentage of taxable component, and over time it reduces. The issue is that every subsequent time you do the strategy, the less effective it is in reducing the taxable component. Because some people make the erroneous mistake of thinking when you withdraw the money out of your pension, you can choose to just simply pull the 130 or the 390 out of the taxable component. Well, you can't. You have to take it out based on whatever the prorated or proportions are at the point in which you pull it out. So that means that you can technically never get the taxable component to zero unless your superannuation balance is lower than what the total amount that you're pulling out is. So if you only got $100,000 in super, you could do a full recontribution and will make the taxable component zero. Or if you've got a super balance that's under $390,000, then you can pull it all out and put it back in. That is a complete refresh to zero. But if you're higher than those amounts, then it will just proportionally get lower and lower. Think of it like this. Imagine your super is a jar filled with blue marbles and red marbles. The blue marbles are taxable and the red marbles are tax-free. Every time you do a recontribution, it removes a mix. But every dollar that goes back is entirely red, being the tax-free. Over time, the jar becomes redder and redder, and eventually there are far fewer blue marbles left for the tax office to tax. So you got to remember the important rules, and here are 5 quick ones. Before you go rush out, rule 1, you make sure that you're actually eligible to withdraw, usually over 60 and retired, or over 65, or you satisfy another condition of release. Rule number 2, you must be eligible to contribute. Remember, there are contribution caps. Currently, the non-concessional contribution cap is indexed and many people can contribute up to the annual cap or potentially, as I said, use the bring forward rules if you're eligible. Rule number 3 is age matters. Contribution eligibility rules become more restrictive as you get older, so the earlier that you can try to do this maximizes the amount of cycles you can actually do recontribution on. Rule number 4, cash flow matters. You need to physically withdraw the money first and then recontribute it. You can't just take the components within the super account itself and just relabel it for your own benefit. And the final rule is remember the estate planning consequences of what you do. Because a recontribution strategy works best alongside a current binding death benefit nomination, in conjunction with a valid will, in conjunction with appropriate enduring powers, so power of attorney and enduring guardian, so that you have a full circle estate plan to cover in any unintended situations. So should you consider this? Yes. It's something that you should definitely talk to your financial advisor about. Should you do it yourself? Probably not, because you have to understand the componentry of your super. So it's a little bit like doing open heart surgery for yourself. but it is something that is well worth having a conversation with your advisor about when you get a chance. Hopefully that resonated with quite a few of you. If you have any inquiries, please reach out to us. You can find me on all the socials, LinkedIn, Facebook, and otherwise. And with that, I'll see you in the next episode.
This podcast is not financial product advice and is intended to provide information only. It does not take into account the investment objectives, financial situation, or needs of any person. You should assess whether the information is appropriate for you and consider talking to a financial advisor before making any investment decisions. Any investment examples are for illustrative purposes only. The information is taken from sources which are believed to be accurate, but Simon Wu, Jonathan Wu, SWU Financial Planning, and Personal Financial Services Limited accept no liability of any kind to any person who relies on the information contained in the podcast. Unless expressly stated, none of the information should be taken as a recommendation. For more information, please visit www.simonwu.com.au.